Back in 2013, I was part of an effort called London Derivatives Exchange to build an alternative to swap futures. And we designed and built and put live on Eurex a constant maturity future on an interest rate swap curve. What is a constant maturity future? Well, now we call them perps. And we launched this with Eurex. We went out, we marketed, we tried to make it work. It commercially didn't work because people found some flaws with how the mechanism would work, and they felt that they would have capital extracted. And this was largely sort of big insurance and big buy side players who did the analytics and said, we can't launch this and use this as an alternative because we'll have positions that will be sizable relative to the volume, and people can move the volume around to extract capital from us. Mechanic, though, has been adopted further. So like shorter stuff, like some of the rolling spot futures, you see it around that, some VIX CMF stuff. It's been used for that mechanic in other places, but that's the traditional market's first use of concepts that date back 20 years.
How would they have extracted value from those large players?
You have funding windows. In that particular one, it was a single overnight window, but these windows are much more frequent in some of the stuff that's around crypto. So let's say you have an 8-hour funding window. Let's say if you hold a large short position, all you've got to do is push the perp price above the spot price with a leveraged buy. And if the market is not got a lot of depth in it, maybe the people who are trading it are retail speculators, so they're not there trying to drag the thing down all the time. It doesn't have a lot of professional players in it. All you've got to do is move that market above that number for the point that the funding rate is calculated. And it's calculated on a moment. So short-term push, and then you unwind it yourself the other way. So you get some slippage with the buys and sells, but you don't get a lot of slippage. And if you've got a fairly large position, you can extract a decent amount of capital from it.
Did the product trade?
No, not on Eurex it didn't, because 2 or 3 of these big buy-side entities picked this up during that market adoption. It got support from FCMs, it got designed and put together, there were market makers ready, but the buy-side entities, I think we had prices on the screen from market makers. So there may have been some small trades, but I don't recall precisely. The paper wouldn't use it, because as they went through their due diligence process, they realized that was an issue. There was another issue they had as well, that they couldn't book it through the custody entities because the funding rate isn't a standard part of how futures markets work. So trying to get adoption across institutional entities is chaining together lots and lots of technology. But the main issue is that they were worried that if they established a big open interest, it would be exploitable by other players in the market.
How do you think this would play out for perpetual futures in crypto today?
This is happening every single day. I see entities that are running this, market makers nod and smile and look the other way. They're generally unregulated venues. There's a lot of sort of exploit plays going on, but this is just a background constant. Are we able to push this today? What's our position? And they might be long on one exchange, short on another. If they see the opportunity in the thin market, they'll move it. But this doesn't take a lot. If we're like a small altcoin, you might be able to make movements to give you thousands of percentage in annual ROI with 250K down. It's not taking substantial amounts of money. If we're talking Binance Bitcoin, then you probably have to have a couple of 100 million down to make 5 to 8% ROI on this, and then you've got your capital at risk in the interim of whatever the delta movements are, because you can't move in and out. But for everything else, there's plenty of scope in there. So if we had a single stock set of perps and it was mid-cap stocks with a couple of millions worth of total cap in the marketplace, yeah, you could extract 5% a year out of that with very minimal capital risk. One of the aspects is that the market is bifurcated. Almost all of these perps, the market makers are net long and the retail is net short. And this extract is almost always spread across a whole bunch of retail positions. So retailers become accustomed to the fact that they have to pay funding rates on this period basis, and that's part of the cost of being in the perp. But when you add them up over a year, that's quite a lot. It's quite a lot of drag cost.
What are the advantages of the perp?
Structure. It's mostly about accessibility. So if we roll our way back to 2017, when everybody was trying to bring more people into the crypto space, the big issue was that we suddenly had to do KYC on a lot of different people getting access to these markets. And the perps was a way of bringing leverage to the market. They couldn't launch futures because you need a regulatory license to be able to launch them. There were some exceptions for fully DeFi, but the big exchanges were they're off chain, and they wanted to be able to sell leveraged products to people in the market. And if you look at what a CFD is, ESMA has said that perps will qualify as CFDs. They're very similar. You're just playing around with some of the funding structures on the end of it. And that meant they could call them a perpetual future. Technically wasn't in the regulation, and they could go and market to retail without needing a regulatory license.
What would you recommend instead of perps?
Futures solve most of the problems. If you are not sensitive to interest rates, futures are generally a pretty good product. And the issue is that retail can't get to them without a lot of jumping through hurdles. We would have a better experience for retail people if they were able to get to mini futures in a more convenient manner, because there wouldn't be as many routes to manipulate them. So I would say we probably need to find a way to enable futures trading on a greater scale, because there's clearly a demand to bring this capital into that marketplace. And we don't want it sat offshore in dark locations where we're not sure that those people will survive any manipulation or pressure that happens to them, let alone the other security issues that there are around some of these exchanges.
What advice would you give an exchange making one of these contracts?
I would know that they were focused on retail and retail acquisition, but I would be saying, as things move forward, if you can get to a place where the regulatory licenses enable you to have futures, bring those out as well. That don't have a business plan that expects large-scale institutional adoption of perps. It's not happening. They're not going to come into that space in that same way. They want to access futures. The really big issue is that the buy-side entities that are in crypto, the native ones that want to hedge, family offices, foundations, they can't come in to the traditional space. They don't have the right sorts of assets to access CME via FCMs. They may be very well established, very clean entities, but they can't come over the line the other way. So they're using probably more options than futures to do their hedging. They should potentially be using futures most of the time. And they can't access those because perps has too much manipulation and too much risk. So they maybe write a swap or do a set of options with a market maker instead, and probably pay a little bit too much in theta.
Is there any way to take out that risk?
No, not really. You can shorten up some of the cycles, you can cap the rates, but it's always manipulable. So that very structure itself is always manipulable at some point. You can't have a funding rate that's attached to the price difference that is not a function of the open interest and the volume. It would need to be back to the drawing board to rethink how funding rates need to be adjusted. Or you could close them one evening and open them next on a cost of the carry and force a cost to carry through based on some rates curve, like the overnight lending rate of Bitcoin or something. But I don't think any of that stuff is practical. I think we are going to be stuck in a world where until the retail guys can offer futures to people, they're going to be offering a product that is extracting something like 8% a year of that capital just to hold the position.
What is the impact of auto deleveraging?
Auto deleveraging is the replacement for a default process in most of these crypto exchanges. And essentially, it says when you run out of margin, we are going to take your position and we're going to pro rata or some other algorithm allocate it to the people on the other side. The issue is that, as we said earlier, the buy side and the sell side have different positions. The retail is always net long, which means that they all start to run out of IM around the same point. So you get the fact that then they're all auto allocated and you get this cascade effect. And it's what happened in October when there was a big drop in Bitcoin. It's what's been utilized to drive it with Jelly when that went to Hyperliquid, where they also have a pool of like almost a default insurance pool that's getting some portion of the clearing fees, and that all got allocated. The loss got allocated back against that, and it just bled that pool out because there was limits on positions, so people couldn't even buy positions back to reduce the price back to where it should be. But the fundamental piece is, if you don't have a default process, if you don't have a mechanic that says, right, what happens when people do default to promote market security, so market stability, you're going to be in a position where when those defaults come in groups, which they do, you get these cascade effects. And that's what knocked Bitcoin off its perch back in October. So that needs proper clearing. But the majority of the people in this space, all these big exchanges, is all vertically integrated with their clearing entities, and all of their incentives about acquiring as much retail as they can, not about building out a complex process in the default to make sure that they've got a mechanic to keep the market together when there's a big hit. Also means you need diversity of utility. You can't have all of the shorts still liquid and all of the long gone in one go. You need to have options, you need to have sorts, you need to have other stuff in there that mixes up that utility, which is why perps make it particularly difficult. Perps and options together, you could kind of work on a portfolio basis, but you need a mix of utility in one place to be able to create safety. Otherwise, you're just putting up a bunch of funds to be sucked out by somebody like they did on Jelly, who knows how to go and do that at 3 a.m. on a Sunday morning when it's not liquid. The idea that we should bring single stocks into this and single stocks should be used by a ton of retail people when 3 a.m. on a Sunday morning, the number 100 in the S&Ps is being squeezed on some third tier exchange and it just goes and wipes a whole bunch of people and wipes out their stock is scary.
What happened with Jelly?
Essentially, the attacker manufactured the liquidation, which dumped this big short position onto their vault, which is the sort of community liquidity pool. It's the closest they have to a default fund. They put a big position on and they squeezed the reference price in the underlying stock up in illiquid hours. So it was a second tier token. It was not expensive to drive up that position, and there's no position limits relative to the size of the underlying. So they had a big derivatives position, small target stock underneath, pseudo stock. They drove up that reference price, and then when it auto liquidated and it wiped out everybody else, their short position paid out. The long positions that they bought into this got liquidated because they kept the initial margin low, and it dumped the excess loss into the community pool, essentially transferring money from the community liquidity pool, the default fund, to their short position that they had, sorry, to their long position that they had before they drove it up, and then cashed that in and moved that off that market almost immediately. It was auto deleverage manipulated with how that HLP vault was working that did this. I mean, the hyperliquid's unregulated. It's got a lot of interesting technology in it, but if you've got no KYC on the way in, you have a massive competitive advantage over people who actually have to stop and check on that. You can do some minimalistic fraud checks on them, but you still have this huge competitive advantage over people who have to run full KYC, full understanding, full source of funds. So they can offer this retail product out to a lot of people. And when we say Jelly, it feels like that's some esoteric stock that we don't know about. But number 107 in the S&Ps is CME. So if this was to happen in a year's time to CME's stock in an out of main exchange window, when the reference price underneath was being passed around by some form of grey book spot on that for tokenized CME stocks, it would have a completely different effect on the press. They've proved that there's no standard, no arbitrage price for perpetual futures. There's no place where we get a convergence guarantee. So it's marked that in the same form as this, it's considered an unsolvable problem.
Why is there such a high interest in these products?
Because everybody who wanted to be able to trade all of the asset classes has been able to, because they were unregulated to get access. So I worked with a gambling company a few years back, and we were looking at bits of money movement in it. And it was a big, like a number 2 in the world poker platform. And we were taking in 70,000 people a day around the world on a churn. The number of people who want to get access to products to speculate and gamble is enormous. The barriers in front of them doing that in traditional products are huge. If you want to go and get access to futures as a regular Joe on the street, you can do it, go and do it. You can go and set up brokerage accounts and do it, but you can't just download an app, send some stablecoin in and start trading. And you can with these. The barrier to entry is really, really low. That's their appeal. Their appeal is, I've come home from an evening out drinking on a Friday night with friends. It's 10 o'clock in the evening, and I want to now do something that's going to give me some more dopamine. So I download an app, I stick $100 in, and instead of playing poker, I go and buy a bunch of meme tokens, and then I look the next morning and I have lost 50% of my money and I take it back out. And then the following week I go and put it back in. Same demographics as the poker people.
How will the exchanges deal with all the new technology?
we've got this massive amount of tokenized collateral coming in. You can't put that through the FCMs. The big exchanges can't take it because they're dependent on the FCMs. So you're going to get competition from these guys as they come towards the regulatory space and try and capture the institutional market. So then what do you do if you're running CME or you're running ICE? You can't jump past the FCMs and go into direct market access. The FCMs aren't going to move fast because there's so much infrastructure in the way. I'm going to say the sort of controversial thing. I think we're at peak exchange. I think we're at the absolute top of CME and ICE and their relative market share and position because this market is going tokenized and it's going to tear up lots of the different markets as the crypto space and the digital space moves like through Canton and through entities like this into this world of regulation and starts to support regulated workflows. It's going to eat at the sides of these businesses. So if I was running CME or ICE, I would be like, okay, right, retirement time. That's as good as it gets. I'm stopping. I've got to get out of this because I would look at that market and go, a year's time, there's going to be three challengers out of the other space, and I'm trapped by my ecosystem and infrastructure from being able to be agile and respond. It's not, take ICE 15 years ago, the most agile business in our ecosystem. Yeah, they can't move into this space fast. They're going up against their own customer base. It's really fascinating.
What are your thoughts on how the prediction and crypto markets have almost merged together?
That's really interesting. So looking at Kelshi, and I've seen Andy Ross has gone there, which is everything I read from Kelshi is all about the institutional business. And I hope that's true because if it does go down that route where it's really trying to be robust and supportive, it's got a really big future as a new part of how we price information. The alternative is just a on the fly speculative gambling place. If it's going to be lots of pop-up markets where there's no protection for insider trading, then it's just going to be another place where there's an extract of something that's creating a load of dopamine, getting a load of money in, but people are really just getting taken out by the entities that are in there at the moment. So it's just another gaming. And the DCO applications that I've seen in that space are interestingly vertical and thin. None of those is ever becoming a QCCP. They're there to give themselves a full footprint inside the CFT to say no to the gambling commission. Doesn't feel like they're there to be the next generation of how we should move this space forward. And obviously, building and clearing, I look at QCP. How do we build a QCCP for crypto? It's a lot to do. I look at those guys and I think they are very much going after their niche. Kalshi's really interesting, but when I was doing some payments work 15 years ago, I met the guys who founded OnlyFans. And I talked to them about their plans in very early days. And they told me about their plans for chefs and IT project people to push stuff and chess and all of these different things and how people can monetize the viewership in a better way than what was out there. And then the money started flowing in for the niche that they're now famous for. And they stopped trying to push in that space. So that's the question for these new prediction markets. If they start to capture lots and lots of retail interest on everything random that's going on, are they going to continue to focus on driving institutional use of these to add some extra value into those portfolios of professional trading houses? I'm not sure. I can see that Kalshi and Bitnomial are kind of some different directions on some of these guys.